What is capital rationing for small business? Hello, YouTube. I'm Dr. Dave Maslach. I'm talking to you about reciprocity.com. You can check out with earlier videos, but today I wanted to talk about the idea of capital rationing and what is it. So this is the idea where you have a certain amount of revenue or a certain amount of resources available and you want to divvy it out across different spending categories in your business. So it's essentially you have a zero-based budget, so a budget that sort of restarts on every month or every quarter or something like that, and you have to use up all of that revenue in a certain amount of time. And what you're doing is allocating to different categories where you think you want your business to go. So I wanted to sort of point this out as a lot of people sort of think that the way that you grow your business, I get this a lot. So I'm actually a professor of innovation in entrepreneurship, in strategy at a large state institution in Florida. And what a lot of people think is they come and they ask for different small business grants, for example, small business loans, or some sort of small business lending. And what they're going to do with these different resources that they get, the loans, the grants, and the lending, is that they are going to use that to grow their business or start their business. That's probably the biggest thing. They think that they're going to start the business. That's probably the wrong way of doing creating a business, particularly small businesses. They're really extremely risky. So you don't want to start with debt and especially a large amount of debt. Maybe a little bit is fine. We often hear about these different stories about how startups, for example, the way that they do their first round of financing is they get credit cards and they get a large number of credit cards. First of all, it's a very, very expensive form of financing. The interest rates on that kind of stuff is really high. But then second of all, the reason why those interest rates are really high is because it's very, very risky. So there's this risk return relationship that you get. The more that something is risky, the higher that the interest rate you're going to pay on it. So instead, what you should be doing is doing sort of capital rationing with your small business, and you get a little bit of revenue coming in, however you're generating that revenue, and then you divvy it up into different sort of spending categories for the future, just like some sort of budget or something like that. And you sort of do that wisely. And then once you sort of figured out what streams of revenue, what are your revenue sources, what are the things that are actually generating money in the long run, then it might be okay, but you have to sort of really question whether you should do this. It might be okay to apply for a grant or get some lending to reinforce that growth that you already have. But you have to sort of be very, very confident that it's actually going to grow in that area. The reason is because if you get a large amount of debt early on, you're going to spend through that, and you're probably going to spend it unwisely, and you're not going to know what you're doing. So it's better to do something very small. So if you look at what I'm doing with reciprocity, for example, it's not the best. I would love this to be a lot bigger and a lot better than what it is. The reason why I'm growing this and doing these sort of YouTube videos is to grow an audience first. It's really incredibly important where you grow an audience, and you do that slowly, and it'll grow slowly, build some trust with you in the audience. I know that some of you are following along. And that's just my goal, is to build some trust and to give back as much as I can so that you will begin to trust in the platform and start building something with me, right? And then once it actually starts growing, then I can find somebody else. I actually don't want to do this in the long run. I don't want to actually do these sort of YouTube videos and stuff like that in the long run. But what I'm trying to do is actually get it to a point where it's actually growing, and then I can hand it off to somebody else, and they can sort of manage this kind of stuff for me. I love doing these videos. It's a lot of fun to talk to you and all that kind of stuff. But my main focus is to grow this so that I can actually do more research and to help out graduate students and stuff like that. So you can watch earlier videos when I'm talking about what I'm trying to do with this. So what are some sort of reasonable sort of estimates for resource allocation in sort of companies. Well, a lot of large companies, the way that they generally spend, these are rough ratios, in very, very rough ratios. Is different for every industry, different for every company, and the strategy that you have. But you want to think about roughly about 5 to 10% are spent on some sort of marketing of the revenue that you get. 5 to 10% is spent on R&D or long-term projects, long-term growth opportunities. And then even in there, when you have these sort of R&D projects, long-term growth opportunities, you want to sort of segment those off and pick the ones that have the largest amount of potential. It's capital rationing in research and development. Then you roughly spend about 30 to 40% on salaries and wages in your company. The rest is like taxes and things like that. And as well as the rest is after that, probably about a quarter is spent on taxes, maybe a little bit less, maybe a little bit more. And then the rest of that is for like for administrative support and things like that. So that's the general ratios that you want to sort of think about when you're setting this up to grow your particular company. And that's why you should start off small, and as you start getting revenue, you want to think about those proportions as you go forward in terms of resource allocation. That's going to grow. It's going to grow your current revenue streams. That's what the marketing's for, and then that's also going to grow potential new opportunities. That's what the R&D is for, and the rest of it is sort of make sure that you have operational support and it's running properly in the long run. And you just kind of gradually grow slowly over time. And that's what you want to think about with that. And then if something is really taking off and something's just exploding, then it could be okay to go get a small business loan. Think about going and maybe getting some debt to sort of increase that growth, or going and getting external financing, like from a VC partner, for example, or an angel investor. They're going to want to look to see that there's revenue, a very large growing revenue stream anyways, not just number of users on a system and things like that. They want to make sure that it's actually producing revenue. That's really important. So once again, if you like these videos, you like what I'm trying to do with reciprocity, it's crowd sharing, the sharing economy proofreading application software that I'm trying to build out. I need more people using it and checking it out. If you want to join, that's fine. You can check it out. But you can also follow along every Saturday. I'm going to try to do every Saturday a video about sort of small business, entrepreneurship, innovation, things like that. So you can come back next Saturday and watch that, or you can subscribe to the YouTube channel and watch these other videos. So thanks, and have a good day. Take care. Bye.